securing new ground last year with Phil McIntosh, the chief economist for NASDAQ. And the Economic Outlook series is really our effort to provide our members with expertise shared by nationally known and very well-respected economists, as our guest is today. Now, given the results of the CPI that was released this morning, that Curtis is undoubtedly going to speak about, and of course, the release of the Federal Reserve's Beige Book later this afternoon for further analysis, our program today couldn't be any more timely. So I'm also proud to be a member of the U.S. Chamber of Commerce, of which Curtis is the chief economist. So it is my pleasure to recognize Curtis Dubay, who is the chief economist for the U.S. Chamber of Commerce. And prior to serving his current role, Curtis was a senior economist at the American Bankers Association, a research fellow in tax and economic policy at the Heritage Foundation, and previously worked at PricewaterhouseCoopers, PwC, and the Tax Foundation. Notably, Curtis has been called upon by Congress to share his expertise on multiple occasions and frequently appearing on CNBC, Fox Business, C-SPAN, the Wall Street Journal, the New York Times, among many other media outlets. Now, let me personally say that I have been a member of the U.S. Chamber of Commerce with the organizations I work for, including SIA, for approximately 15 years. In my opinion, this is by far the most influential business organization globally. Earlier this year at our Security Leaders Forum, we were honored to have Neil Bradley, Curtis's colleague, speak to us about policy issues. But if you're not a member of the U.S. Chamber of Commerce, I promise you, you will definitely gain value by participating in the Chamber's various committees and activities. So with that, Curtis, thank you again for making time, and we look forward to your presentation.
Thanks, Don. Thanks for having me today. It's a pleasure to be with you all this afternoon because there's a lot going on in the economy. I've been calling where we are in the economy the waiting place for a long time now. We've been stuck in this spot where we're waiting for a recession to start. We're going to talk a lot about the waiting place and how we got here and how we get out of it. What you need to know for you and your businesses is that we're going to be in for slower economic growth eventually. It seems to be coming soon. But then again, I've been saying that for over a year now. But there are some signs that the economy is finally starting to slow. But we're also really in a very unique economic period. And that uniqueness might make the coming slowdown not as bad. And once we get through that period, things do look pretty good. So I'm going to tell you what's going on in the economy right now. I'll talk a lot about inflation, its causes, how it'll come down, the Fed and interest rates, and then give you the economic outlook for 2024 and 2025. And particularly what you need to know for your businesses. I'll talk about some risks that all that analysis, and we'll do some Q&A as well. So please be ready with questions, and you can put them in the chat, and we can read them from there as well. Also, I should note, I'm going to use a slide deck with some charts. That is available for all of you. I've sent it over to SIA. They can distribute it to you. Each of the charts and slides has extra data, annotation, and analysis. Please use it as you see fit. You can distribute it widely. That's what it's for. So, like I said, we are in the, and I'll share my screen now. There we go. Like I said, so we are in this spot that I call the waiting place, and we've been there for an awfully long time now. We're here in this waiting place because everyone thought we'd be in a recession by this point. If you went back to the beginning of the year, everyone, myself included, was predicting the economy was going to slow down going into 2023. That's because we were coming off a pretty strong 2022, and the economy was facing a lot of headwinds: inflation, higher interest rates to combat inflation. And the consumer just, the perception then was that the consumer just couldn't keep up for much longer. Here we are, 6.5 months into 2023, 2 quarters behind us, and the economy is holding up remarkably well. It grew at 2% in the first quarter, which was way higher than anyone thought. We were looking at negative growth when that quarter started, and there it is growing at 2% last quarter. And we won't get the second quarter data for a couple more weeks still, but it's looking like the economy grew between 1% and 2%, probably closer to 2% when all is said and done. So again, another pretty strong quarter. The resilience of the economy really has been remarkable, but it really boils down to the remarkable resilience of consumers. consumers have been the ones that are keeping the economy afloat. They've been able to keep spending for a few reasons. And again, we've been expecting consumers to not be able to continue spending ever since COVID ended, and we moved back into a more normal economy. But here we are in July of 2023, and the strength of consumers continues. It really boils down to three main things. One is that jobs remain plentiful, and income growth has been pretty strong. If you want a job, you can have one. So that means that if you are working, you can, if you're working, you have a job, you're earning pretty well, you can continue spending. Even though inflation was running higher than wage growth, it was still, wages were strong enough to help you stay afloat and help you keep spending. And it really we'll come back to this again and again and again, the really unique state of the labor market. The reason why you can have a job if you want one is that we have 3.7 million more job openings than we have unemployed workers to fill them. And that enormous gap has existed ever since the middle of 2021. So over 2 years now, we've been in this unprecedented situation where the number of job openings far outpaces the number of workers available to fill them. So if you have a job, if you want a job, you can have one. Your wages are growing, and now they're even growing above inflation. So that's going to help you keep spending as well. But for most of the last couple of years, in fact, ever since for over 2 years, inflation was outpacing wage growth. That means that consumers had to rely on two other things to keep spending stable. One was built up pandemic savings. All of us accumulated a tremendous amount of savings during COVID. We're talking a couple of $1 trillion of savings above what we would have saved during that period. So if you look at this chart, every bar that is above the dotted line was savings above the pre-COVID average. Those bars added up to a lot of excess savings. Now, we've been below that dotted line since January of 2022. So for 18 months now, we've been saving below the pre-COVID average. We've been spending that balance down. It's probably largely gone. There's probably a couple $100 billion of excess savings. And we don't necessarily know who has that. The ones who need that the most have probably spent through their savings at this point. But that helped keep spending up for a long time, as did credit card balances. We paid down our balances tremendously during COVID. And ever since then, we are building them back up. Now, they've been growing pretty rapidly, and that's helped bridge the gap between inflation and incomes. Usually when credit rises that rapidly, it's concerning. It hasn't been such a problem this time because, again, we paid the balances down, and as a percentage of income, it's still well below the average of the last 20 years. So there's a little bit of capacity left for consumers to continue using their credit cards to bridge that gap, to buttress their spending. But that's really winding down. So those three things combined, while they have kept spending strong, we've all been expecting them to finally give out, that income growth wouldn't keep up with inflation, that savings would run out, and credit card capacity would erode. I think that's probably finally starting to happen. But with the thing that's really been that has really kind of pushed spending even a little bit higher is that those who aren't constrained by credit or inflation or the need to use savings have been spending tremendously on things they couldn't do during COVID. So they're traveling, leisure and accommodation, they're going to live sporting events, the theater, things like that, things they couldn't do during COVID, and they're spending an awful lot on that. So we end up in this weird limbo where we're all waiting for a recession that seems to just never come. We're also back for a while, if you go back, maybe a year or so ago, we talked about this situation where we called it secondhand pessimism. And that's kind of back. What that was businesses and individuals telling us that their personal situation was good, but that the economy is on the wrong track and the economy is bad. Consumers are saying the same thing right now. Consumer sentiment is as low as it's ever been, which is really kind of surprising, but they obviously continue to spend. Businesses are saying that the economy is bad and going to get worse. And at the same time, they're hiring, they're spending on capital expenditures, they're doing things that don't necessarily jive with their perception of the economy. I don't know what to make of all that. I just know that this situation can't go on forever. And before we go forward, I just want to point out one thing. So I've said that consumers have been spending and kept the economy afloat for a long time. It does seem like consumption is slowing a bit. As you can see, that the dark blue line has kind of come down in the last few months, saying that's telling us that maybe consumption isn't holding up, and it only just barely kept pace with inflation last month. So with all that said, we can't stay in this waiting place forever. Something has to push us out. We never stay in a stagnant situation. So something is going to happen. And it's most likely going to come from the tightening of credit conditions that will arise from higher interest rates to combat inflation. So the Fed raising interest rates. This could include what happened with the regional banking system a few months ago. When interest rates rise, things get squeezed, and that includes banks. What we had was a straightforward banking situation where some banks, particularly SVB, Silicon Valley Bank, got caught with very long dated securities at very low interest rates while interest rates were rising, and it ended up in a very bad situation. First Republic Bank was heavy in commercial real estate, which we'll talk about in a little bit, and Signature Bank was heavy into crypto. Very straightforward banking situations, and then spilled out to other banks that had similar situations as SVB. We seem to have moved past that since then, but credit conditions have certainly tightened. We know that from all the surveys that come out from the Federal Reserve and other supervisory institutions. So there's definitely a lot less credit than there was, but things aren't as bad as we would have thought they'd be at this point. So all that said, where does that leave us? I still think it's a really good chance that we end up with a recession either the last 2 quarters of this year, so starting now, and the 4th quarter of next year, or the end of this year and early in 2024. And the reasons would be everything that we've been talking about. And when I say recession, I'm talking a pretty small one. We can go back to this chart as well. So a mild drop, maybe 1% of the economy. The requisite 6 months. 2 consecutive quarters of negative economic growth, which we'll probably talk about in a little bit. But it's going to come from consumers just not being able to keep up anymore with their credit being zapped. They're running out of savings. The real wages really just treading water. Real wages, inflation-adjusted wages is what I'm talking about. And then rising interest rates sapping business investment and other consumer spending. And then the reason why I brought up the regional banking situation is that when you have big changes in interest rates, something usually breaks. Now that could just be the regional banking situation, which is going to translate into slower economic growth at some point, because those are the banks that do the kind of nuts and bolts, really bread and butter lending to small and medium-sized businesses. These are the type of banks that businesses go to when they need to finance a new warehouse, or they need to buy a new piece of equipment. They don't go to the big banks. Those big banks don't have that relationship or that lending capacity to deal with these businesses. And those are the businesses that are going to see the tightest squeeze on their ability to lend. When I say we get a recession, it could be what I call a tree falls in the woods type recession, which is that we could have one where jobs increase, income grows, spending remains somewhat stagnant, or maybe even grows a little bit, and manufacturing output increases. Those are those four data points are the things that those economists who determine when a recession occurs look at. All those things could increase. So it's similar to the question of if a tree falls in the woods and no one hears it, did it make a noise? If you have a recession and all those major things that actually matter to people increase, did you really have a recession, or does it really matter? That said, there's still a chance we could stay out of a recession too. It would be because of the unique situation we have, particularly in the labor market. Businesses are and I'm sure you are all in this situation. I talk to a lot of businesses, it's probably a survey size of thousands now, and all the different meetings and events that we have here at the chamber. I always ask attendees if they are getting enough workers, if they have all the workers they have, and only one person in months and months of asking this has said that they do have enough workers. So that unique situation where businesses have to continue hiring to staff back up because they've been so shorthanded for so long, that could keep wages and incomes relatively steady and could keep us out of a recession, keep us from falling into one. I should say that there have been lots of, until recently, some kind of headline stories of lots of layoffs, particularly at very well-known companies. I never thought those were emblematic of anything going on in the broader labor market. I thought those were businesses that were using a potential economic slowdown to right size their labor force. And they hadn't really, these businesses probably overhired during COVID because their businesses were expanding during that period, and they were taking this time to right size them. I didn't think it was emblematic of anything going on in the broader economy. Another thing that could help is somewhat similar. Businesses are finally able to rebuild their inventories or getting our supply chain healed. And so businesses may continue to spend even during an economic slowdown so they can get workers back to the number they need and have their inventories fully stocked up so they don't get caught in the difficult situation that they had during COVID and its aftermath. Okay, so a quick recap. What does this mean for the rest of this year? I think the economy is going to be soft. I think we're going to have slow growth for the remainder of the year and into the early part of 2024. For your companies, for security companies, I think you can probably tell me better in Q&A, but I look at it as a pro-cyclical or a cyclical industry. So if you have a slowdown in the economy, it's probably going to mean a slowdown in your business as well, but probably not entirely cyclical. I mean, security is something that all businesses need to spend on, but I think it's certainly looked at as kind of an investment. So businesses are going to spend more when times are better. To the extent that, and so there's certainly going to have some businesses that hit rougher patches and see security as a kind of a more of a luxury spend item and might push that off for a while until things are better. Interest rates really matter right now. You're not really all that interest sensitive yourselves, but some of your businesses and your clients are going to be, particularly those who are building new buildings, whether they're commercial real estate or industrial, and on the residential side. Excuse me. So there's some things to think about. For residential, the residential market is likely to be okay. It's probably bottomed out when it comes to residential and housing. The interest rates hit that very hard at first, especially higher mortgage rates, but we have a huge shortage of housing units. So I think the housing market is actually likely to rebound, and already really has started to do so. Industrial spending, I think, is likely to continue okay, particularly manufacturing or construction of manufacturing plants. That has seen a real big boom lately, and that has to do with the major legislation, the infrastructure bill, the Inflation Reduction Act, and the CHIPS Act, putting a huge onus on reshoring certain types of manufacturing capacity here in the US, and it's really showing up in the macro data. So if you service those type of buildings, those are more and more coming online. It's already started and will continue for the next couple of years. Office space, though, I think is something that requires particular attention. The office space market is in limbo and waiting right now, but it's really starting to tilt. And the reason why it's been in limbo is that prices are falling because of a large number of vacancies. Office occupancy is still below 50% in all of the 10 major cities, the 10 biggest cities that Castle tracks each and every week. And that means the office space market is in for a really rough few months as it adjusts, and we see some foreclosures or business or building operators just turning over the keys to their lenders. It's going to be turbulent for the owners of those buildings and their lenders for a while, but I do think it will turn around later this year, early next year, once the market starts moving, and we find a bottom to the market. Excuse me. But office space is certainly something to keep an eye on as we go forward. So that's the overview of the overall economy. So now let's turn to inflation, which has, of course, been the thing that we've been focused on for so long. Excuse me, just let me clear my throat. Okay, so inflation. We got data today. This is the the broad number when it comes to inflation, consumer prices, the consumer price index, it came in at 3% on an annual basis this year. Here's a couple things to keep in mind, because you're going to hear a lot about inflation today. Certainly going to be some folks taking a victory lap saying that it's over and we beat it. Not quite. If you look at the chart, you'll see a year ago, June of 2000. So the data we got today is for June of 2000, is for June. But if you look a year back, June of 2022, that's when we hit our peak, almost 9%. That means that the data that we're getting today is compared against the highest number we had in 40 years. It's called a base effect. But that means that that calculation will be, you're basing the change off the highest level we've had in a very long time. That kind of pushes the annual number down. That said, we're clearly headed in the right direction. But the Fed looks at more than just this broad number. It looks at things like, it strip out volatile elements like energy and food. That core number is still very high, it's still about 5%, and it's been stuck there for 2 years. So we have a ways to go. The way I explain it is that we have been lost in the woods for a very long time. We were really, really lost in the woods a year ago. We're still lost in the woods. We're finally on the path out. We can see the exit, but we got a long way to go, and a lot of things can distract us from there. So we're on the right path, and we're really making progress to the end of it, but we're not quite there. A lot of things can knock us off path. So don't look for any changes from the Fed on its monetary policy. They're very likely to raise rates again. Is it next week or the week after? I checked the calendar. But they meet here in July. Likely to do one more increase. Excuse me again. I would have said that I anticipated 2 more increases this year, so one in July and then one again in the fall. I think the chance, because of the better top line number, that the likelihood of a second increase in the fall has dropped some. We'll have to see, but at very least, they're going to raise rates again in a couple of weeks because of the persistence of that core number, which is starting to ease somewhat, but is still very high. Remember, the target for the Fed is 2%. We're still 50% above that at 3%, but if you're looking at core, we're still 2.5 times above that. So much better than where we were, but still have a ways to go. And again, that's the dotted line is the 2% rate. You can see we're still well above that. You can see why inflation would be zapping consumers' strength. This is food at home. This is grocery prices. They're up 5% on an annual basis. There was a point where they're up almost 14%. Food prices have been running higher than the rate of inflation. Energy, even with gas prices coming down, has been running above the headline rate on inflation, as has the price of housing. Housing is still up 8% on an annual basis. Now, mechanically, housing is pushing the core inflation number up. It will push it down later in the year because it takes a while for housing data to filter through the inflation data. So we're still getting the run up in housing prices that occurred during COVID is still filtering through the inflation data. The decline in housing, or the pressure coming out of the market, is not filtered through all the way. Once it does, it'll help push that core number down probably later this year. So I do think it's also important. This is getting less so as we've been dealing with inflation now for over 2 years, but we hadn't had a bout of inflation for 40 years. We hadn't had a bout of inflation like we've gone through since the early 1980s. So I do think it's worth a minute or two to go through why inflation is bad. I mean, from a family perspective, you're going to get a decline in real savings, inflation adjusted, not savings, spending. It's going to squeeze your family budget. You can lead to higher interest rates to lower inflation, meaning that you get less business investment, less consumer spending. You get less spending on housing and other interest-sensitive items. But inflation is also really bad, and I think you probably all understand this very well now, because it grinds investment to a halt because no one can plan. You don't know what your workers' wages are going to be or what they're going to be demanding. You know what your input and material costs are going to be, your transportation and shipping costs, the prices of your product in the future, what the cost of capital investment is going to be. All this causes so much uncertainty, investment grinds to a halt, and it leads to shortages because no one knows the answers to any of these questions. So we've all been through this at this point, but it's still a useful refresher because this is all new for a lot of us. The causes of inflation really boiled down to two major factors, and I put them in two buckets. One was transitory, temporary, and the second was more long-lasting. The transitory, temporary ones really had to do with COVID and the supply chain. So we switched from demand of the US economy is about 2/3 services, 1/3 goods. We switched from demand for services to demand for goods. That put strain on the supply chain. Then we increased overall demand with all the fiscal stimulus we did during COVID. Savings went through the roof because we couldn't spend all our money because we couldn't spend on services at all. And there was a constraint on the number of goods out there. That increase in savings dragged out the increase in demand. We had worker shortages because of COVID. And that just led to a huge bottleneck in supply chains. You know all this, and that drove prices up. We're past that. There was a much longer lasting issue, and that's what you're seeing in this chart here, and that has to do with the money supply. I'm a free market guy. I always stick to what Milton Friedman said, which is that inflation is everywhere and always a monetary phenomenon. In this case, it's the long-lasting inflation, which is the monetary phenomenon. The Fed increased the money supply by roughly $8 trillion in nominal terms, and in real terms, it probably increased it closer to a couple $1 trillion. That's that hump you see in the chart. It's not a criticism. This is not to criticize the Fed. It did what it had to do to prevent a global financial crisis, a global economic collapse during a pandemic. So it did what it had to do. What happened was the timing got away from them. They wanted to withdraw all that support from the economy once we got past the virus, and then hopefully escape without causing inflation. They know you create this much money, you know you're gonna get inflation. But Congress passed and President Biden signed the American Rescue Plan in March of 2021, just when the economy was starting to take off. It threw a tremendous amount of money onto an already pretty much a roaring economy, and prices took off really fast after that. And the Fed ended up in a rock and a hard place. The COVID was still a problem in March of 2021. Vaccines weren't widely administered. We hadn't gone through the Delta variant and then the Omicron variant, so it was still very much a problem. They didn't want us to withdraw support because they were afraid of the virus. At the same time, inflation started to take off. Either way, both the supply chain COVID issues and the huge increase in the money supply led to too many dollars chasing too few goods and services, and prices rose. I put 1/3 of it on the supply chain COVID issues and 2/3 of it on the money supply increase. So we would have had a huge increase in inflation even if we hadn't had the issues that were directly related to COVID. So how does it all come down now? So you can see the money supply has finally returned back to trend. If you look up at the corner of the chart, the dark blue line has now gone back onto the dotted blue line. The dark blue line is the actual course of inflation adjusted money supply. The dotted line is what it would have been had we never had the COVID era. The dotted blue line and the dark blue line have finally merged and come back together. So we are now back to I'd say a neutral monetary policy. That's one of the major reasons why inflation is coming down so much. And the Fed has done this. It's shrunk the money supply by raising interest rates, really basically from 0 to now 5, a little over 5.25% in the federal funds rate, probably one more increase, a really sharp increase in just over a year and a half, not even a year and a half, just over a year. March of 2022 is when they started raising rates. Those higher interest rates have led to lower demand, which has put downward pressure on prices. Tightening lending conditions have meant less borrowing, and you're starting to see inflation cool. So it'll take a couple of years. It took a couple of years for inflation. So remember, we started all this increase in money supply in January, February of 2020, inflation peaked in June of 2022. That's over almost a year and a half. It's going to take roughly that much time for the inflation to fully come back down. So even though we're down to 3% from a headline standpoint, we're not going to be back to that 2% target anytime, I would say middle of 2024 before we're back there. The other thing that means is that if you watch any of the financial press, as some of us do, financial markets are just really, really dying for a rate cut. That's not going to happen. The Fed is likely to stop raising rates, but they're not going to cut rates. They cannot cut rates because they've got to get inflation back down to that 2% target before they even consider doing that. So interest rates aren't going to come down until very, very soonest, middle to late next year. And even that would have to require some softening in the economy that I don't think a lot of people are predicting right now. Those higher interest rates certainly are doing their job. The average rate on a 30-year fixed rate mortgage is now almost 7%. It started last year around 3%. That had a big impact on the housing market. Prices have come way, way down. Now they're negative on an annual basis as of April. That again has to do with base effects. From month to month, they've actually started rising pretty substantially again, which means that to me, the housing market has bottomed out in terms of prices. And I never thought we were going to have a big problem in the housing market because we do have a couple of things that are very different than, I guess it's almost 20 years ago now. One is that we have a huge shortage of housing. There's way more demand than there is supply. That's going to keep prices up. And then there's a lot more equity in housing. And the finance is not nearly as precarious as it was back in, say, 2006. But we're certainly at the beginning there, when mortgage rates went up, buyers left the market. That meant that there was a heck of a lot less demand for new houses, which meant that there was less demand for lumber, steel, appliances, all the other inputs into a new home or an existing home. There's lots of things that you buy when you're buying a new home and you're moving. So demand for all those things fell pretty rapidly as soon as those mortgage rates started to tick up. And there's also other interest sensitive items as well in the economy, whether it's home repairs and improvements, cars, home furnishings, appliances, electronics, boats, RVs, trailers, vacations, you name it. Anything that requires financing is going to become more expensive. And we saw a pretty abrupt decline in demand for those things. And that helps put a downward pressure on prices. Business investment matters too. The price for businesses to borrow goes up. That means there's a lot fewer projects are profitable, and you see a pullback on business investment spending. The average rate on a AAA rated corporate bond is now 4.5% or so. It started last year around 2%. You can see how demand is going to seep out. The decline in demand or downward pressure on demand is going to seep out around the economy when these interest sensitive sectors are hit immediately when interest rates start to rise. A key thing to remember about inflation is that, and bringing inflation down, is that prices will not fall. They're just going to stop rising as much as they were a year ago. Prices don't fall. Think about this in your own business for two big reasons. Well, three really. One, businesses don't like to cut the prices of their goods, but they don't like to do that because workers generally don't take lower wages, and their suppliers and the inputs into their product or their service don't usually cut their prices as well. So I don't think we're going to see prices fall. We're just going to see them stop rising as much as they have, and that's okay. That's enough to bring inflation to tame inflation and bring it down to manageable levels. So before I get into where we go for the next couple of years, I did want to do a quick rundown, back to another history lesson as to when we were getting into this bout of inflation. A lot of us were looking back to the early 80s, so that was the last time it happened. But a lot of the fear of what could happen in the fallout of very high inflation and rapidly rising interest rates came from what happened in the early 1980s. Keep in mind that in the early 1980s, inflation had been embedded in the economy for a decade or more. People expected high inflation because it had been a part of their experience day in, day out for a decade. And inflation expectations matter immensely when it comes to inflation because inflation is largely psychological. We act in ways, when we expect inflation, we act in ways that cause inflation. We try to buy things today to get ahead of higher prices tomorrow. That drives up demand in the here and now, and raises prices. It gets a lot harder to root out inflation when people expect inflation to be high. Back in 1981, then chairman of the Federal Reserve, Paul Volcker, raised the federal funds rate to 22%. Is anybody on this call that bought a home back then? They can attest to the high rate they paid on their mortgage back then. Remember, we have a 5.25% federal funds rate that's going to top out at probably 5.5% or maybe 5.75%. It's a far cry from 22%. Now, that high interest rate had three impacts. First, we had a severe recession in late 1981 and into early 1982. We actually had an inflation in 1980 as well, so we had a double dip recession in a very tight window of time. But the economy grew very, very well, very strong. We haven't had a period of similarly robust growth since then, all the way up until the S&L crisis in the late 1980s. And then, even more importantly, inflation was tamed for 40 years until March of 2021. It's a period in economics known as the Great Moderation. So this is not 1981. Inflation expectations remain anchored. This is financial market expectations of inflation. They're right around 2%, just slightly above it. They went up a bunch early last year, and they've come down and stayed down since then. So inflation is not ingrained in our minds. If you go back and you pull, and I have this chart if you're interested in it, in 1981, consumers expected inflation to be 10.4%. That's why things were so much different back then. All this means that it should be less economic pain to root out inflation now than it was 40 years ago. And hopefully it comes down faster. Now, keep in mind that psychology is a big part of inflation, and economists are not people. It's not really our thing. It's why we became economists. So there could be a lot we don't know. And in fact, Chair Powell, Chair of the Federal Reserve, said at some point that it turns out we don't know as much about inflation as we thought we did. Now, that's really a terrifying thing for the Chair of the Federal Reserve to be saying. It's a lot like going in for open heart surgery and your cardiac surgeon telling you he doesn't know as much about hearts as he thought he did. But I think Chair Powell was being very, very frank and showing his humility in the understanding that economists are not psychologists. So again, the point of this is we could have a much softer landing than we did back then. It could still be a hard landing, but I think that likelihood is falling, and it has a lot to do with where inflation got to and expectations, and those unique labor market dynamics. Having so many more job openings than we have workers to fill them, I think that kind of puts a floor below how far the economy can fall. So for 2023, I think, again, it's a soft end of the year. 2024, the beginning's probably soft as well. But overall, I think 2024 will be better than what we've had here, what we've had in 2023. But it's really 2025 when things look a lot better. We'll be finally fully be past inflation and ready to take off. We won't be we'll have kind of become accustomed to the higher interest rates. We might even see rates starting to fall by late next year and into 2025. Inflation will be behind us, COVID behind us. And really, this is important. Usually when you have economic issues like we had with COVID and then with the inflation, other things in the economy break, bubbles burst, dominoes fall. That didn't happen. We don't see any underlying structural problems in the economy, or any sectors that are struggling or industries. That tells me that the economy was in really good shape in February 2020, and that it can return to that once we get past our current issues. So my final thing on the outlook is that be ready for a softening in the near future, but be ready for a much stronger economy come 2025. Now, a couple of things, risks to everything that I've run through today before we go to Q&A. We couldn't know not as much about inflation as we thought we did. Chair Powell could be prescient. It could get worse. I think that the chances of that are lessening each and every day. There are always unknown unknowns, a dot-com bubble bursting, a financial crisis, another pandemic. or a new unknown unknown. You can't discount geopolitical problems. Russia, Ukraine spilling over and getting worse, China invades Taiwan, or another thing popping up. And then lastly, our own political risks. We've gotten past the debt limit, but we still have some issues with having to pass a budget, which could, if we don't do that, could end up with a government shutdown later this year. So with that, I'll stop. Like I said, things will be better and good fairly soon if you can just wait it out. Thanks.
Curtis, that was awesome. This is a perfect example of the value that SIA and by extension its members receive by being members of the U.S. Chamber. I mean, really excellent, insightful. You hit on all the key points that I think are of interest to our audience. And by the way, speaking about our audience, we have an unbelievable turnout from LinkedIn community. We're streaming live, LinkedIn and YouTube. So really appreciate the effort you put into the presentation. Let me start, if you don't mind, with a couple of questions that are in the chat related to the commercial property space. So the first question is, how are the office space vacancies going to be filled? Do you believe that they will be converted to other uses like residential?
Great question. We just did a report on this, so it's really timely, and I've been thinking and talking a lot about it. So here's what's going on. People are not coming back to work as quickly as we thought they would. So we have a lot of office vacancies. So the businesses are not renting as much office space. They're not leasing. They're not buying. So that market is weakening. Now they are coming back. Businesses want their workers back. They want them back for two really big reasons. One is that the productivity is a heck of a lot higher when they're in the office. Actually, it's all connected to productivity. They want them back for two reasons that filter into productivity. One is that a lot of what goes on in the modern workplace happens via informal channels. So that report that I was just talking about on office space and the future of how it's evolving came about because I bumped into a woman that I hadn't seen in person in years at the water cooler. And we started talking, and we ended up coming up with the idea for that report. That happens all the time across all these different businesses. And managers know this, and that is not happening on Zoom and Teams. It cannot happen in a virtual setting the way it happens organically when we're bumping into each other. So businesses know this, and they want their workers back to this. I just read an interview or a statement that Jamie Dimon made. I think it was here at the Economic Club in DC yesterday, saying the exact same thing. All that stuff that happens just because we're around each other isn't happening, and it can only happen when you're in person. So they want them back for that. And also, they want to know what workers are up to. You can't monitor what people are doing when they're at home the same way you can when they're in the office. There was a study from the New York Fed that showed we kind of know that less productive workers tend to choose remote work, but at the same time, even more productive workers are less productive when they are working from home. So that's why they want them back. They can't get them back. It's hard because of all those, the labor dynamics mean that it's workers who have the power right now. That's why wages are growing strongly. It's why workers can say, we don't want to come back into the office, and businesses can't make them. One of the ways they can help entice them back is with nicer office space. So modern new office space is doing okay. It's older buildings that are having a hard time that are not in prime locations. So if you're not in the core areas of New York, San Francisco, DC, places like that, and you have an older building, those are the ones that are struggling the most. I do see convergence happening in those, and it's going to be a mix of residential, commercial, retail, and then other congregation space. It's still happening on the fly right now. We're still trying to figure this out, but the unlocking of the broader office space market as those valuations come down and those 5-year mortgages turn over and they have to do refinancing, it's kind of move this forward in the coming months. If you want to talk more about this, I've done a lot of stuff on this, and actually the Wall Street Journal has a video up on their website on how it's very hard to retrofit office space to other uses for lots of reasons. Permitting and zoning regulations and environmental regulations, which is what we found in our survey, are a big hurdle. But even if you can overcome those things, office space is made to be office space. It's very hard to convert it into other uses. But we have very innovative architects and people in this industry, and they're coming up with really cool ways. The Wall Street Journal has a video of how they're taking this high-rise office building down basically off of Wall Street in New York and converting it into apartments, and it's really neat. I suggest you check it out.
Well, first of all, your passion for this topic is palpable, so I appreciate it. We definitely need to have you before our SIA Prop Tech Advisory Board at some point, have some dialogue around it. You answered the second question, I think, to a degree, but let me just go ahead and read it for the record. A recent Wall Street Journal article on June 6th detailed the extent of interest-only loans on commercial properties and the pending interest rate reset over the next 3 years. What is your view on the Class A commercial property market going forward?
Yeah, okay, so the other thing to point out is that commercial real estate is, I think the market's $22 trillion in size. Office space it was 15% of that, so $4 or $5 trillion. Commercial real estate in general is okay. It's that $4 or $5 trillion office space market, which is the problem. Commercial real estate in general is okay because people are gravitating away from urban cores to spending more time where they live. So strip malls, smaller office spaces, all those things that are closer to our homes, they're doing fine. It's those high-rise office buildings, those urban cores, and other office space that is the problem. Those tend to roll over 3 to 5 years. I'm not an expert on the financing, but from what I understand, as those start to roll over, it's the higher interest rates combined with the lower valuation because of higher occupancy that is going to be the problem. So I foresee a bunch of foreclosures. It's not even going to be foreclosures. It's going to be the owners of those buildings saying we can't make the math on these buildings work anymore, and just handing them back to lenders. And that's going to bring prices down, which is actually helpful because there's a kind of a freezing of the market. You need to unfreeze it. And the way you unfreeze it is by finding how far those prices have fallen. And that process really gets that underway. And it's starting to happen too, because I think the FDIC has a big portfolio of buildings now from probably mostly from First Republic that it has to sell off. And that's helping to unlock the market as well. So I do think that there's going to be some pretty substantial problems in that area. The lenders to those owners for those buildings know this is coming. They should be well insulated against the losses they are likely to incur. But there's probably going to be a few out there that will take a pretty big hit.
Good. Jeff, is a follow-up question?
Sure. So we have some questions that have come in over social. Curtis, one of the questions is whether there is any specific data related to inflation on technology prices, especially business technology prices.
I don't have that off right on the tips of my fingers, but tomorrow we'll get. So today we got consumer prices. Tomorrow we'll get producer prices, and in that producer prices, you can go and look at the change in prices for things like that. If you shoot me an email, cdubay@uschamber.com, I will, when I'm pulling through that data tomorrow, I will shoot you a note and let you know.
Another follow-up question from the Q&A. Notes that in our industry, some vendors are still having some supply chain issues. So as you look at the remaining supply chain issues that you're seeing, are you seeing those being predominantly caused by, one, source raw material issues, number two, manufacturing issues, or three, more shipping and distribution issues, particularly labor issues?
From what I understand, it's all of the above. And I think it's also residual impact from everything that happened over the last couple of years, that there's still these pockets of things that are not fully resolved, and that we still have, something might be resolved for a little bit, and then because of things that weren't fully resolved, ends up spilling over, and you get backups again. And remember, China's had a very choppy restart, so we get these periods where things get back to normal, shipping costs come way down, get back to a more normal routine coming from China to the West Coast ports. They have issues, that slows down. We have issues with our West Coast ports and labor, and things flare back up again. And I know there's still an ongoing problem with the shortage of chips, which really factors into automobile production. So I just think it's going to be more time necessary to get back to a new normal. It's not going to be normal February 2020. It's going to be a new normal, and that we're still just going to see residual hiccups it'll just take more time before they're finally fully past us.
So Curtis, let me pick up on a couple of things you just said on different topics. We can't have a briefing like this without talking about China, right? And global trends. We just had a visit by Secretary Yellen to China. Not sure most of our members would understand what was accomplished from that visit. May not be as clear. I don't know if you have thoughts about that. Then there's some speculation, I think, as you know, among economists and just business leaders around the topic of deflation in China, just the state of their economy and how that may impact our economy. So I guess I'll put it this way. From your view, is China on the cusp of deflation, and how concerned should we be about that?
It's their data is so hard to parse that I always hesitant to say definitive things about the Chinese, but I think something like that's always a risk when you have a managed economy. They're always trying to fight the issue of at present, and they're always setting up the next problem with what they do to fight that particular problem, and eventually that catches up with you. So it's always worth keeping a close eye on what's going on there. In terms of it's very hard for me to say whether they're going to have deflation. I mean, I do think that when it comes down to it, they have population issues that their population has peaked and that it's coming down now, I think, and that's going to be deflationary. And then you had a lot of investment in things that were produce no return, and that eventually is deflationary as well. And I do think they have some debt issues as well, that there's a lot of debt to be written off, and their ability to write that off and paper over it is, they've done it so far, but it's not infinite. They can't do it forever.
Okay. And unrelated topic, talking about the banking industry tension a little bit, you touched on that. Our industries are not unique. There's a lot of M&A transactions that occur within the security industry. What is the long-term impact, you think, on M&A from some of that tension we've seen from the institutions you mentioned earlier, for example?
Well, so I think there's a little bit separate, because the funders of M&A are not going to be the banks that are under scrutiny. The banks that are under scrutiny are regional banks. It's just because that's the size the SVB was. They have about $225 billion in assets. That's below a globally important financial institution size. So every bank kind of below that was pretty big got scrutiny. And the ones that were under the most pressure were regional bank that had a huge increase in deposits. Now, a lot of them had big increases in deposits, but really big increases in deposits, uninsured deposits that were above 250,000. And then those that tended to be really on the West Coast, there's a very heavily in tech, venture capital, funding new businesses, those businesses having to do something with the money, putting it into banks, and then withdrawing it once they actually became a viable business and actually started hiring and buying things and creating the business. So those are the institutions that got the most scrutiny. And then, of course, those who made the mistake of buying long-dated securities at low interest rates. So that's why it was focused there. Now, the impact on M&A, though, hopefully the regional issue is over. That the Fed did a really good job of getting. The issue was certain size banks needing liquidity to get through runs. I know we're in a digital age, and you can read the stories about SVB and the text message threads between all the tech people out there withdrawing their money all together on the same weekend. And the role of technology played in that, but it's a run no different than what we saw in It's Wonderful Life. Hopefully we're past all that. When it comes to M&A, the issue is that money is a lot more expensive now. M&A is a lot easier when interest rates are very low, and now money is a lot more expensive, and it's going to be that way for a while. So I do think you'll see some cooling on that. There's so a lot less money sloshing around. There's just going to be a lot less appetite for risk as well, because you can make money on your savings now for the first time in 15, 20 years. So you have to clear a higher hurdle to get people to invest and to put the money up for those type of deals. That said, we get a lot of very smart people who exist to do those deals, so they'll find ways to find funding for them. It's not that they can't find the funding; it's just going to be a lot more expensive, which will make fewer of those deals go through.
So we have time for, I think, one or two more questions. Question from the chat. Curtis, does everything you talked about put the crown back on the theory of cash is king? If so, is the relevancy of the subscription economy a way to combat the uncertainty in technology consumption?
I'm reading it. That's a really interesting question. It's probably better for somebody who's better versed in the tech world. I do think that the flow of the cash flow that comes from subscriptions is still very highly valued, but I think that the number of things that are conducive to that type of spending are really minimal. And so I think we kind of hit the ceiling when it comes to that if you can make it a subscription model, you've probably already done so. And then we've even seen that, so for the longest time, we all wanted to be able to pay for subscriptions for entertainment technology. So like when my kids were younger, it's like I'd pay $20 a month to have the Disney catalog easily available rather than having to go find the DVDs and turn them over all the time. Turns out that wasn't a very good business for Disney, even at less than half that price. So there's a lot of things still to be learned from the technology economy and how to become profitable. A lot of businesses still aren't profitable that exist in online, and there's still a lot of venture capital funding for them that kind of keep them going until they become a viable business model. I think so. A couple high-profile ones that are understandable. Twitter, Elon Musk get a ton of money for that and trying to figure out how to make that a viable business. And then just things that we thought were revolutionary, like Uber and Lyft, just aren't the same as they were pre-COVID, because they aren't. I live in DC and I work in DC, and Uber is not the most reliable and least expensive thing anymore. I rarely go to it like I did pre-COVID because it's just a much different thing than it was back then. So that's what I'm probably not the best person to answer that, but on your cash is king. Cash is always king. If you have cash, you are always the most agile, and you're always able to take advantage of those opportunities that pop up.
Well, we appreciate your thoughts on that last question. So Curtis, this has been outstanding. And I've received a number of texts throughout the presentation, particularly from board members and variety sized companies who are members of the association who really valued it. So it meant a lot to us. And I want to thank you and the U.S. Chamber for making time to share your insights with the SIA membership.
Sure, glad to do it anytime.
That's great. Thank you, Curtis. And thank you everybody for joining today.